Is the housing finance system sick? Welcome to the Industry Leader Update by Reverse Focus. As a reverse mortgage professional, have you ever stopped to ponder the forces that are behind the American housing market? Just what makes the lending world keep turning around? Also, what natural or artificial forces are at play that can influence home prices and affordability? The Mortgage Bankers Association President, CEO, and also former FHA Commissioner David Stevens said that the real estate finance market is stuck in the same sick system as it was prior to the 2008 housing collapse. Now, such a comment should raise the question: is our economic and housing recovery the result of natural market forces or artificial government intervention? First is the question of the role that government-sponsored enterprises, or GSEs, that Fannie and Freddie Mac actually play. It's 4 years later and the government isn't still just the backbone, but it has become the entire central nervous system of the real estate finance market. When the federal government is still backing nearly 90% of the mortgages made in today's market, it's apparent that the real estate finance system is stuck in the same place it was when I took this stage 4 years ago. One of the MBA's initiatives is a push toward more private capital with limited government guarantees of mortgage loans. Now, they believe these agencies have actually increased costs while limiting accessibility to the American home buyer. Stevens cites the average borrower's credit score being 741 with loans which are backed by Fannie and Freddie, leaving an estimated 10 million qualified families on the sidelines. Beyond the dependence on the housing market on these federal agencies is also our country's monetary policy. The Federal Reserve has kept interest rates at historic lows in the wake of the economic crash of 2008. Housing starts and purchases of existing homes have benefited from these artificially low interest rates, which has fueled the recovery of the housing market. Now, like most, a growing housing market is good news, but a recovery, is that sustainable? Or more importantly, is it vulnerable in the future? A modest uptick in mortgage loan interest rates would substantially impact a still fragile market. A recent housing report, in fact, shows that home prices are slowing in the majority of metropolitan markets across the U.S. Will our collective addiction to cheap money come back to haunt us in the future? Perhaps. Now, the government is faced with the thankless task to gently taper our money supply and also interest rates while preserving our recovery to date. When it comes to these federal agencies, which Stevens argues are the central nervous system of mortgage lending, politicians also are beginning to take notice. The Johnson-Crapo bill would slowly wind down and eventually eliminate both agencies. Not surprising, since the CBO, or Congressional Budget Offices, estimates the true bailout cost for Fannie and Freddie at $317 billion. Today's housing market is both vulnerable and dependent. Vulnerable to the Federal Reserve's monetary policies and interest rates, and also dependent on Fannie and Freddie to provide liquidity and capital to the housing finance market. Now, what are your thoughts? Do you think that our present system is sick or dependent? And what future impacts do you anticipate? Leave your thoughts in the comment section below and have a great day.